Hey everybody, I'm Austin Lieberman, and I'm here to teach regular people like me how to grow wealth over time without staring at the stock market all day. In the next 5 minutes, I'm going to tell you why I invest my own money in dividend growth stocks and 5 traits that I look for to help me identify the best dividend growth stocks in the world that I want to own in my portfolio. And then we're going to take it from academic, where I'm just talking to you and telling you these 5 traits, to show you a real world example of a company that exhibits those 5 traits that I own in my actual portfolio, so that you can actually hear it, learn about it, and then see how it's applied to investing. So we take it from academic all the way to application on this channel. Before we jump into the 5 traits, what I want to do is share my screen and tell you what a dividend growth stock is. And so just at the most basic level, a dividend growth stock is a stock that pays a dividend out to shareholders and then grows that dividend year after year. So if they pay $1 in dividends in the first year, they might raise that the next year to $1.05 or $1.10. That's the example of what a dividend growth stock is. Now let's talk about why I like to own them and why I think they're a great option for investors to consider. And this is from Simply Safe Dividends. I am a paying subscriber to this service. This is a free article, 5 reasons to be a dividend growth investor. We're not going to go through the whole thing, but what I'm going to show is right here, this chart right here, which they got from Ned Davis Research, and I think it was in 2018, but the numbers still basically apply. This is stocks within the S&P 500. We can see here that dividend growers and initiators, so that's a company that is starting their dividend, on average provided a 10.07% annual return. Dividend payers, 9.25%. No change in dividend policy, 7.47%. Non-dividend payers, 2.61%. Dividend cutters and eliminators, negative 0.35%, and then equal weighted in the S&P, so this is just owning everything in the S&P 500, 7.70%. So just a quick look from 1972 to 2017, which is kind of before some of the craziness that's gone on in recent years. Dividend growers and initiators were kind of in the top area of returns, 10%. So there's a historical precedent for the quality of company and the quality of returns that you can find from dividend companies that are paying and growing a dividend over time. And so now let me give you the 5 traits right up front right here, and then we'll go through each one of them step by step and try to keep this thing under 5 to 8 minutes. Trait number 1, 5+ years of EPS or earnings per share growth. Trait number 2, 5+ years of dividend growth. Trait number 3, rising free cash flow per share. Trait number 4, an earnings payout ratio below 60%. Trait number 5, net debt to EBITDA below 3. And so now let's actually apply this and show how these traits are exhibited by a real company that I'm a fan of, that I own shares of in my own portfolio, Lowe's. And again, this is from Simply Safe Dividend. They do have some free stuff, but I've got the paid service, so I'm not sure exactly what you can see for free and what you can see for paid. But the first trait that we talked about is 5+ years of consistent earnings or earnings per share growth. And actually, I'm going to hop over to Fast Graphs and show this. And there's ways you can look at this at Yahoo Finance and in different ways, but I'm just using the tools that I like to use that save me time and sharing them with you and sharing this information with you. So EPS growth, we can see right here that from 2003 all the way to 2020, let's look at the change per year here: 42%, 22%, 27%, 21%, 15%. 08 and through 2010, the great financial crisis, of course, those numbers went down, but then they got right back on track, and they're still growing strong. Had a monster year in 2020, fiscal year 2020, fiscal year 2021, and even after those strong years, they're expected to still continue growing their earnings at 13%, 11%, and 12%. So right there, Lowe's checks off box number 1, 5+ years of consistent earnings or earnings per share growth, and the expectation for continued earnings growth moving forward. Trait number 2, 5+ years of dividend growth. And so again, the cool thing with fast graphs is it shows this as well, all the way from 4 cents a share in 2003, growing it every single year, including during the Great Financial Crisis, which is pretty crazy when you think about the earnings drop there. Still growing it, still growing it, still growing it, all the way to $2.30 last year, expected to be, $3 in the most recent full year, expected to be $3.36. So to grow by another 10% or so in 2023. And if we look at that over time, over the last 20 years, the dividend has grown at a compound growth rate of 33%. So trait number 1 and trait number 2 checked off for Lowe's. Rising free cash flow per share. And this is where I like to jump over to Simply Safe Dividends. Time to wake up. And they've got some great dashboards for all of this stuff. And so this is a awesome thing I like to look at on Simply Safe. Dividend streak, 59 years without a reduction. And down here, they've actually got the dividend growth streak, 59 years of consecutive dividend increases. That's kind of insane. But let's get down to the rising free cash flow per share. You can find this in a company's earnings, in their earnings reports, their SEC filings. But I like to use tools that make things simpler and faster. 1, because I share information out publicly and it just makes it easier to collect everything. And 2, because I'm one person and doing my own research and trying to save time. So free cash flow per share. And this is going all the way from 2013 to 2022. And we could see it is rising, 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 rising. They've had some years where it's dropped. Sure, that's okay. As long as we're confident in the outlook for the company and what the company does, then we're okay with that. As long as it does become a consistent trend. And so 2021 all the way up to $12.04 of free cash flow per share. 2022 was $11.90, and yep, that's the last 12 months. So trait number 1, 2, and 3, which is rising free cash flow per share, is all checked off for Lowe's. And just to define free cash flow per share, that's what's left over after a company has paid all of its bills and reinvested to maintain and grow its business. Advantaged businesses tend to generate stable, growing free cash flow over time, fueling sustainable and rising dividends. And that definition is actually from Simply Safe Dividends, which is a quick and easy and understandable definition that I think is great to use and easy to refer to. Let's talk about trait number 4, earnings payout ratio below 60%. And we'll define that one up front. The earnings payout ratio is the percentage of earnings paid out as a dividend. A rising payout ratio means the dividend is growing faster than earnings, or that earnings are declining. A volatile payout ratio can indicate less stable business. So an earnings payout ratio below 60%. Right here, Simply Safe Dividends, they've got this visualized as well, really easy. And we can actually see that from 2013 to 2020, it stayed, right around 35, down into 33, 32, up to 37%. And then with the crazy, growth that we saw in 2021 and 22, it's actually gone down to 26 or 25%. So as an investor, what that tells me is that if things stay consistent, Lowe's has a lot of room to continue growing their dividend and just get back to the normalized level of payout ratio that they had before 2020. So we'll see what happens. I'm sure, there's going to be some, it's hard to exactly predict what's going to happen with earnings over these next few years, just because of how crazy everything has been with COVID, the Ukraine crisis. So I'm not expecting that to be immediate necessarily, but it definitely gives us a lot of room for safety. Trait number 5, this is, probably the most complicated, but it's the net debt to EBITDA below 3. And so EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And that indicates how many years of EBITDA, which is a proxy for cash flow, a company would need to pay off all its debt, net of cash on hand. If leverage rises too high, a company might cut its dividend to free up cash flow for debt reduction. So we want to make sure that the company can handle its debt and still pay and grow its dividend. And again, back to Simply Safe dividends. They've got the definition here, and then they've got the net debt to EBITDA ratio visualized very nicely. Below 3 is what they prefer. And we could see Lowe's has never really even come close to 3, and now they're even lower the last 12 and expected for the next 12 months. And so that covers it for this video, I think. Let me stop sharing my screen so you can see me here. This has been Austin Lieberman. We went a little bit over on time. We're at 11 minutes now. I hope you enjoyed this video. Please like and subscribe. Like this video, subscribe to the channel. It makes me feel better about myself, helps more people find the channel, and it makes sure you never miss an update. If you want more in-depth research than I can really do here on YouTube, I do have an email newsletter, austin.substack.com, which is linked down in the comments below. And finally, also linked in the comment below, or the description of this video, commonstock.com. I have my portfolio linked so you can see the companies I own. You can see when I make buys or sells, which 90% of the time I'm going to be buying because I'm buying companies over the long term. And if you want to see another video that talks about how dividend stocks fit into my overall strategy for a portfolio I'm building in real time from 2022 to 2032, I just made a video that explains all of that. And you can see it in the channel. I've got a playlist here that's the 10K to $1 million portfolio. So check that out as well. And you should be able to click that on the link above.